You should be obsessed about who your customers are, how they think, what do they do, what do they look for, who's listening to this podcast? Are these entrepreneurs that are trying to raise equity because they're going after the big?
Welcome to Hello Grow. Today we have Landon Ainge on the podcast with us. Stoked to have you, bro. Thanks for making the time. I know you're in high demand, so appreciate you making it. Quick intro is Landon, you got an undergrad from BYU. You have an MBA from the University of Utah. You cut your teeth in the business world at Goldman Sachs, it looks like 1 or 2 times at Goldman. And then you went to Savage where you did M&A. From Savage, you went to Overstock.com and were head of product. You helped build and own the P&L for their entire mobile. And then after Overstock and I want to talk about why you made the switch. You went to Kickstart, and it's a VC fund here in Salt Lake.
Yeah.
And did a bunch of diligence on entrepreneurs, it looks like there, and fun and deals. After that, you went and started your own thing as a co-founder of Gabb Wireless, which is a massive company, and everyone in Utah knows about it. So I'm excited to hear about your time there. From Gabb, you left to go do a bunch of cool like side quests. It looks like you made it, and then you went and started Tribe Angels. You started your own angel investing, and now you run Initiator Co., where you help entrepreneurs navigate getting funding.
Yeah, I mean, it's a really long bio. It's like the worst having to tell it to everyone. That's what I think you're asking me to do, right?
No, we won't go through everything. Yeah. So
yeah.
Let's start with the switch from Overstock to Kickstart. Because you had Goldman, Overstock, Savage, kind of like these corporate jobs.
Yeah.
And then you went to Kickstart, which is very venture capital.
Yeah.
So talk about what was going through your mind, what stage of life were you in, and why did you make the switch?
So it's a good question. So I was in a corporate environment, publicly traded company. I ran my own division. We were growing well. I think what I learned was that I really had come from kind of a sports background. In my mind, it was all about the team. No individual player actually mattered, is my perspective. And when it came to coaching and sports, that world. And when I was in the corporate world, it very much felt like a politics game where whoever's the loudest or demands the most attention is going to get it. And I didn't care about that. I just went around to every team inside of a corporate environment and said, what are you bonused on? What are you bonused on? Okay, great. Now I know how to make you happy and figure out how you're going to win, because I don't care about those things. I just want the company to have more to the bottom line. And so when we were seeing success, my division quadrupled revenue in about a year and a half, and it was awesome. But I learned very quickly that not everyone had that perspective. They were concerned about who was going to get the credit, and I didn't actually care. And so that plus the aspect of I didn't understand venture because I'd done M&A transactions, buying cash flowing businesses. The thing for me that was fascinating was how can you invest in companies that lose money and expect to make money? That makes no sense. And like any sane person, I decided to join the industry to figure it out. And so I left the cushy corporate job getting paid very well to join a venture capital firm where it was literally 7 people in the firm, and had to adjust that risk tolerance to understand what is venture.
What was your role at Kickstart?
So I was an associate, senior associate there. We joined as a pretty junior role.
So a couple questions about Kickstart, and you can use your knowledge that you've obviously gained since Kickstart.
Yeah.
But seeing companies there, you got Kickstart and other VC firms invest in 10 companies. They expect 1 or 2 to fail, a couple of them to break even, and 1 home run.
So I'll explain it differently.
Okay, perfect.
Yeah, so I would say most funds are typically somewhere between 20 to 40 portfolio companies in the venture capital space. And going back to sports, inherently, can't tell, I'm obsessed. Venture capital is baseball. Right? If you bat 300, you're really dang good at your job. So that sounds crazy, but it's the power law that states that you're not going to invest in anything that doesn't have a 10 to 100x multiple potential. And so if it doesn't have that potential, you can't invest in it. This is why it's good for people to know, entrepreneurs to know, if they're taking money from a VC, you can't stop. Like after you triple your business, there's no stopping. Like you're choosing to go down this journey to go take over the world. That is venture capital. And so they expect that 3 of their companies will return basically most of the capital. Mostly 1 or 2 will return almost all of it, and the other stuff is general. And then if they get returns from the other 7, that's just a plus, generally speaking. So as a statistician, I studied stats in undergrad. I was like, okay, this makes sense. It's just like which betting game are you playing? You have to play the odds of whatever game you're playing.
How long were you at Kickstart?
I was only there about a year.
Okay, so within that year and since, what are the things of the companies that did take money that made them successful, and the ones that lost it, why did they lose it?
I mean, it's almost, you can go look at the research and it's like 3 reasons, right? Like they died because they couldn't get customer validation fast enough. They couldn't get more funding because they were still losing money. Or 3, the product never did what they told people it was going to be able to do, right? Whether that's a software standpoint or whether it's a hardware and they couldn't get it functional.
So break that down some steps further. Is that lack of execution? Is it a lack of intellect? Is it bad timing? Is it luck?
All of those things. Like I think it's lack of validation for the first one, right? Like if you don't talk to people that could be your customers and don't understand anything about what they're willing to pay, then that's different, right? You have 3 different philosophies in venture. What I've learned is you have the philosophy that is like, okay, just raise money, then figure out how to build a product, and then we'll find the market, right? And that's the San Francisco way, right? Like Quibi is my favorite example of that, where they basically created Netflix for 15-minute shows, and they raised $2 billion and then tried to convince people that they wanted to watch 15-minute shows, but they never had demand, right? And so
they raised $2 billion?
I think it was that high, yeah.
Holy cow.
Yeah. So that's like one of my favorite examples of like, okay, that's the San Francisco way. Raise money, build a product, figure it out. Like Slack was a key example of that. They were trying to build something else, and they happened to create a messaging app. And they were like, well, we've got some money left. Let's see if we can get people to pay for this. And then Slack became Slack, which is crazy. But they were building a product. The New York way is the way I see it, is of venture capital, is build the most impressive board you can get of all the most high-powered people, then raise the capital, and then through their connections, you're going to inevitably receive success. And kind of the way that I see for the more capital-efficient regions, I call the between the coasts area, you have to validate first. And then once you get to market, then you can raise VC money because there's just not as much capital available.
Okay, so the first one seems like the wild, wild west, and you're playing roulette, and some people are going to win and some people are going to lose, the San Francisco way. The New York way, well, the in-between, that one makes sense to me as well. Get validation. The New York way does not make any sense to me because a value-adding board member, to the degree that they're going to come in from an outsider's perspective and add enough value that they're going to get you from 0 to 1, seems like a stretch.
Maybe. I mean, it depends if you can build a partnership, or if, you need about $1 million in annual revenue to raise a Series A round. So you just need enough for people to feel comfortable, or a partnership that makes them feel comfortable for the next round of investors to say, okay, your next threshold is XYZ. So let's be honest, venture capital is not for most people, right? Like when I talk to people about venture capital, I'm like, it's probably not for you.
What's that ratio of entrepreneurs that you talk to that it's not for?
For most, I tell entrepreneurs it's probably for 3% of all companies. 3%.
That's so low.
It's so low. But why do you hear it? Because it's the sexy story, right? It's the ones that go public, they go big, they're able to grow faster. So it looks and seems like an overnight success, but it's not. They've raised so much money. They've given up a lot of equity.
3%.
But we're talking from different paradigms. Now, going back to the M&A world, you're talking about companies that, they don't raise capital. They make money, and they have to make money. And so capital is a constraint, and that's where they look for lending options, right? So we're balancing equity versus debt. Finance is a word that they say to overarch the two, but they couldn't be more different, equity and debt. And so Yeah, venture capital is for not the faint of heart. Most people probably shouldn't be investors in venture capital unless they trust the person they're giving money to do it, or they like playing roulette. And that's what a lot of angel investors do, is play roulette. I just recommend they diversify.
Fair.
So,
Okay, so the question I had before we segue into Gabb and why you left to go there and your experience there
yeah.
was this. As I was thinking about Gabb Wireless, it's a very mission-driven organization, and thinking about the companies that you saw, missionary versus mercenary entrepreneurs, did you see any difference in financial outcome for those companies that were founded by mission-driven entrepreneurs versus I see a big space where we can make a heap of money?
I would say the biggest difference I see is a sense of urgency. So when I see mercenaries, they need to go now, and they need to go big. And they're often most of the founders that are willing to raise the most amount of capital for the fastest, because they want to be the overnight success. For the mission driven, sometimes I saw, like on the negative, I saw sometimes a lack of forced ability to like make money, and forced behavior to like get validation, have the right business model, all those things. On the positive, you saw what is truly aligned with that path, which is that this is a marathon, so you're not sprinting. And so they were always focused on like, this is what they would do for free, so why wouldn't they be doing it forever? And so that aligns really well. So I think there's positives and negatives for both sides. Venture capitalists, if you're talking about the power law, they would probably skew a little more the mercenary side. For me, I tend to skew the more marathon type perspective. Like, I want the person that, like, this is all they think about all day, every day, not about the next 4 companies they're going to build after this.
It's so interesting as you talk about that, because the first company I started, Aspen, for sure mercenary. Like, chip on my shoulder, left door-to-door sales. I was going to go
age appropriate, right?
25-year-old. I was going to
prove you all wrong
to everybody, like, I'm going to make way more doing this than you guys can make doing door-to-door sales.
Yeah.
And it's going to be this wild success. And the emotional toll on that and the burnout came, but the financial upside also came.
Yeah.
And this next venture, I have not had nearly the amount of urgency other than this solution has to exist in the world.
Yeah.
And we don't currently have the solution, and the problem is rampant. So how do we solve it? So in your experience or your advice, how would somebody go about grabbing those great things that a mercenary brings to the table as in sense of urgency, and couple that with those positives from a missionary?
I would say surrounding yourself with people that kind of push you to go harder, if that makes sense. Having the right co-founder, having the right business partner, having the right team members. Once you've gotten validation, it's about the team you bring on, because you're not giving up as much equity in that scenario. I think that does a lot, because it's all about who you're working with, and like minds around each other. High competition, you're going to push each other to do that. So I think that's the positive standpoint of like getting that mercenary urgency without necessarily killing the culture of the company.
I like that. Okay, tell me why you left Kickstart and why you went to Gabb and that story.
Yeah. So I'm going to tell the unfiltered version that I was fired from Kickstart, a venture capital fund. I was left with like fuel in my fire of like, I'm good at investing. I believe I'm good at investing. I didn't have the time. Talking about that culture, for me, it was a matter of like, I don't think I was a cultural fit there. And that's what they told me. And that's because I take stewardship. I wanted to like change things internally. I wanted to do things. And they were focused on, hey, we need to go to the next step of building our firm unity, not this kind of like pushing forward. I was trying to drive things forward in a different way. And I could tell that they were like, look, we need to go this step and then this step, right? People forget that when you are in a venture capital fund, it's its own startup, right? Just in a different form. You just happen to take other people's money and invest it. Yeah. And so they were at a stage where they were pushing things forward, and they'd really done a good job but they needed more more of a yes man, honestly, to like do some of those things.
That doesn't seem, you're not a yes man, and I appreciate it because I've spoken to you multiple times where in a kind way you called me out on my thinking to challenge and sharpen it. And so I could see that being problematic.
I mean, if I care, I'm going to say something.
Yeah, if you don't care, you'll just be apathetic and just keep your mouth shut.
So for me, it's more questions usually mean interest and ownership and stewardship. And so for me, like that's important. It's what I look for. But it also depends on the stage of the company, the type of leader, everything that's there, right? It's all a matter of how do you like to run your business? I like to be challenged. Tell me when I'm wrong. And so that leads to what's there. Ironically, with the Gabb stuff.
Give us the whole story. Like, how'd you get involved? How'd you meet?
Yeah, so
how did you guys raise capital?
The Gabb story was I got involved because I had left. Wasn't at the VC fund. I was hoping to be able to work for an out-of-state VC to bring them to Utah because I felt like Utah had great talent. I felt like I was good at VC. I wanted to bring out of state, but I didn't have the network of VC. I'd only been in venture capital for a year, despite being well connected.
Does the network of VC mean knowing the entrepreneurs or knowing the LP, the limited partners to bring in the capital?
So in this scenario, I'm talking about neither of those. I'm talking about other venture firms that are nationwide venture firms.
Okay.
And so those it's relationships. But very true, venture capital your success comes from three parties. Large, high net worth individuals that are willing to trust you with their money, entrepreneurs wanting to take your money over other people's money, and relationships with other venture funds that are going to back the next round or the round before you that trust you. So those are the three parties. I didn't have the relationships with the other VC funds yet because I was just focused on doing diligence of the companies and tracking our 90 plus portfolio companies that we had at that time. And so I was meeting with entrepreneurs to keep that flow of deal flow coming. So when I talked to a VC fund, I could say, I've seen 3 really good deals. This is what we should go after in Utah, because I'm trying to convince them to come to Utah. And I met the founder, and he was pitching actually to an older gentleman who was, an angel investor. And I happened to be in the room because they're like, he worked at a VC. He should listen to this. And it was all to the other gentleman there. And I'm sitting there nodding along, and I'm like, okay. And I volunteer at a group with a bunch of teenage boys, 11 to 17. And so like I was very involved with like helping out. And he started talking about all the problems with kids and technology and how they were struggling to communicate. And he'd come up with this idea, and he hadn't told anybody about it. This is the first time he felt comfortable sharing it. And I'm nodding along. I'm like, okay, so you're a marketing company. And honestly, when I do the demographics, I think you're targeting moms, not dads. You should ignore dads. And he's like, who are you, 17-year-old kid? This is me like a couple of years ago, so I looked even younger. But so essentially, I heard his pitch. He wanted to meet and follow up and was like, what are you talking about? I was like, well, I was selling to your same demographic. I was just selling them furniture at Overstock. These are moms. They're high income earners. They care very much about education. They want their kids in lots of activities. And the moms are at home seeing the problem that their kids are having. The dads are, generally speaking, if we're talking demographics, out of the home working, and they're not seeing this problem. So the moms are who you need to talk to. And this is the easy button for parents. So that's what happened. I said, I won't work for you. I'll build your pitch deck. And so he hired me to build the pitch deck. And I won't work for you, but I'll help you raise capital. And then it was like, okay, well, maybe you need to get more traction to actually be able to attract capital because you aren't a proven founder. You've never done this before. And so then I helped him run the Indiegogo. We were supposed to run a Kickstarter, ended up being an Indiegogo. And then we ended up pre-selling $25,000 worth of monthly recurring revenue in the Indiegogo. And I was like, oh, crap, I should join this company I just built. So that was my mistake of adding all the value ahead of time before actually joining. But I ended up joining, and, we launched in September of 19. And, we couldn't convince anyone to give us capital until after we pre-sold 25,000.
And then the floodgates opened?
No, the VCs all still rejected us.
Really?
Every VC that we talked to still rejected us. For some, it was the team. For some, it was, oh, we don't like hardware. Oh, this isn't really that unique. This isn't really a problem. That one made me laugh a lot.
That it's not a problem.
Yeah, just get your kid a flip phone, or you can lock down an iPhone. I said, okay. Talk to parents, right? And the good news is I'd already talked to 10,000 parents. I was like at all these conferences with moms, asking them what age they should give their kid a phone. So I knew more about my moms than anyone else in the world. And so that was there. I was in charge of go-to-market, all of go-to-market and operations. My co-founder ended up leaving the state to go live in California to try to attract big money. And so I was basically pushing forward and running the company on this standpoint while he was trying to build up. And we didn't end up raising big money. We just operated well enough to attract some
You did not raise big money.
We did raise from like a family office that ended up leading a seed round and then some follow-on capital. And then since that time, they've gone on to do it. But all of this happened. We got to about 2.25 run rate revenue, 2.25 million in 13 months.
Wow.
Having not raised VC, we ended up raising like three.
On pre-sales, or did you guys have hardware that you were actually
we had
shipping?
Hardware. We partnered with a out of country hardware company that created a custom built operating system for us, and we just aligned incentives, right?
My nephew has the Gabb watch, so like you guys are everywhere.
Yeah.
It's amazing.
Yeah, so it's great. Like I'm no longer a part of that company. Like it's weird to see my baby like that's there. Like I love that company, but like I'm not a part of it, and that's actually really fun for me to like watch how it's changing and other players come into the space. I really encourage it because it's just technology is kind of destroying our children. So just background for those that don't know Gabb, like it's all about giving age appropriate devices to kids, right? Kids watch, a kid's phone, a communication device rather than a supercomputer. And so I love talking about it because it's what I love, but it's funny because a lot of people will talk to me about Gabb and don't know I was involved with it at all. Or they'll talk to me about kids and mental health, and I'm like, oh, that's interesting. Like I just like to listen to what other people have to say.
Okay, so I have 3 questions. You can go about them in any order. What worked that is duplicatable that other entrepreneurs can do? What didn't that can be some pitfalls that they could avoid? And then the third is a quote from Elon Musk where he says, starting a business is like chewing on glass while staring into the abyss. So I'm curious if you could share one of those or 2 of those moments at Gabb.
Okay. I'm going to go back. I'm trying to think
what
which
worked,
order.
what didn't, staring into the abyss.
So what worked was talking to mission-based founders. I think it's easier to get people on board that want you to win in a mission-oriented company. We had I built the affiliate program from the ground up where it was all performance-based affiliates where I was able to find people that cared about the mission and they would gladly promote it, and then we were able to pay them based upon performance. So getting those was easier because we were mission, and affiliates worked really well for us because of the audience we were going after. What didn't work? The startup stage, I would say looking back, what didn't work was having 2 co-founders in different states focus on such different things. Like if I go back, I wish we would have been able to have more time together. Because we would both come back like exhausted or tired, and I would be focused on the things I was focused on, like, hey, you got to listen, these are the things. And he would come back saying, oh, I'm focused on these things. And it was like at the startup stage, so much is changing every week. It seemed like our priorities were changing every week because of just how fast you have to be moving in that world. And so that communication, I think, could have really improved that, and that would have, I think, helped the company a lot long term. So that's where I would say there. Startups being like chewing glass.
What was that moment? Did you have one of those moments?
Like 7. but I would just say like I didn't ever want to be an entrepreneur. I'm the opposite of someone like you. Like, where you like, it was in your blood. You were doing it at 20. Like, I came from the corporate world. Like, my dad's advice was get a stable job, like all these things, right? Like, I worked at Goldman, big company. I worked for a publicly traded company. I didn't want to be an entrepreneur. And slowly I started to learn that, like, maybe this is right. And so Gabb for me was like, I had to figure out that, like, this is personal. This is something that I can do. I'm telling these entrepreneurs on how to get to 0-1. Can I really do it? Like, there's a lot of people that just that alone puts me on the same footing as a lot of entrepreneurs when we're talking about, like, not very many people know what it's like to go from 0 to 1. Like, the first $1 million, right? Like, that's hard pain. So I remember Christmas freaking out with Gabb. I wasn't sure if we had enough money to be able to get, it was inventory, I should say, enough inventory to get these kids their gifts or getting them on time. In the first Q4, for anyone that's done Q4 sales for consumer products, it is crazy. Black Friday, everything. And it was just like, oh crap, did we oversell? Do we have enough? Are we going to be able to deliver them in time? We promised to get them by Christmas. Oh my gosh, that was
what happened?
Like,
did you?
We were able to get like about 97% of them to them, and the few that didn't were like a day or 2 days late. So like, that's pretty good for consumer products, actually. Like, most people miss that deadline.
Yeah.
So, yeah, grateful for those early believers and early investors and all that goodness. So, yeah, that was a journey for sure.
It's interesting to hear that you're not an entrepreneur, that you didn't see yourself as that coming up, because I feel like most entrepreneurs were selling Gatorades at soccer games when they were 12, right?
Most of my friends, they are all, and I'm the exact opposite. And I think that's where I found my own, like, calling in life, where I'm a better facilitator than I am actually doing it myself. Of like, I can do it, but I actually want my other people to win more than I care about myself winning. And
that team mentality. And
so that's for me of like, okay, I think actually the facilitation here is better, whether that's on the equity side or on the debt side. I think this is my calling in life, of genuinely wanting those people to win more than I do. So
finish the story for me. Bring me from Gabb to present, and then we want to talk about how to leverage capital to start and grow a business.
So the Gabb stuff was, I think I talked a little bit about that tension with my partner. I think that came to light, and so we actually broke up essentially through that time period of COVID. Extremely difficult for me. My whole identity was wrapped up in Gabb. It was who I was. Not to mention just like, oh, COVID's happening. Oh, I have to go figure out what I'm doing with my life, kind of thing. So, had to do some things to make sure that the company was in the right setting and so that it could succeed moving forward. So I would always say that, like, for anybody that has ever broken up with a business partner, it's like, I don't know. I'm always of the perspective that legal is kind of a last resort, like in that scenario. And I'm always like, let's do whatever is best for the company, right? Like that's my perspective. And so we went through that process. I had no idea what I wanted to do, but
can we dig in there a little bit? I won't ask for details, but I'm having had experience it as well. I'm curious, just top few emotions. You were married at this point.
Yeah.
You have
married,
kids.
2 kids.
How did that, so the emotions you were feeling, and then how did that affect how you showed up as a husband and as a dad?
Yeah, for about a month and a little bit, I don't know that I was a normal functioning human being. I'll just put it that way. Like I was like, yeah, probably like a fifth of myself is kind of what I put it. Because it was part of like, who am I? Because most people in their first business wrap themselves up too much that their company is them. Their identity is wrapped up too much in it. And then it was also more of like, okay, I was successful, but was I successful? Right? Like we'd seen success, but what's really success is that second evaluation. And then third, looking into the future, being like, oh, what's next for me? Oh crap, I have to like figure out what I'm going to go do. And so over time, like I started to realize like, who am I? I call it being broken. Like you need to be broken 3 times in your life. Like 3 times.
Why 3?
Like,
Because I think I've been broken maybe twice. So
that's another one.
So why
another
3?
one's coming, right? So usually for some people, it happens in their teenage years or in their early 20s. Something where they like realize they're not invincible, right? Like some sort of moment that's just like crush you, right? Bring you down. And then sometime in like when you feel like you're coming into your own and you're seeing the success, then it happens. And sometimes for people it's later, sometimes it's earlier. When you're having business success, but then something doesn't work out. Partnerships, it could be a divorce, it could be something of that nature where they start to see it. And then the phase 3 is usually like when you have some of the financial success, but there's this like kind of evaluation of what am I going to leave to this world kind of frame of like, who am I and what am I going to leave? Like I was broken at 14, like, which is a weird time to say you're broken, but for me, that was like a really personal thing. And I'm grateful for it. Like it took away the thing that I loved the most, which was basketball. Like, oh, this is taken away from me. I ended up coming back to me. Like health issues for me made it seem like, oh, I'm never going to be able to play basketball. And that was my life. Like, of course. And then I had to learn that I was more than just basketball. So it's like this identity crisis. So I'm grateful that I kind of sped up those difficulties, failures, whatever we want to call it, learning moments. They're all the same. So yeah, that third one though is more about like, who are you and what will you impact the world on? And that one's a good one to go through.
So I think it's likely that most people will figure out as time often heals that identity.
Yeah.
Because our identity is very, I don't want to say has a short-term memory, but a few months span, 6 months, a year span, and then we come into this new identity. Maybe more difficult for somebody that is more in the limelight or had a long 2 decades, 3 decades in a specific thing and then needs to transition out. That'd be very like a J.K. Rowling. I see that being very difficult. Like, there's only 7 Harry Potters. What do you do next? Yeah. So I see that being very difficult. But as far as was I actually successful and now what do I do?
Yeah.
How did you come to terms with those?
I think for me it was looking at like for the people that had achieved monetary success, what did most of them felt disappointment when they achieved it. And so I was trying to say, why did they feel that way? And I had to answer that question for myself of like, it's really about figuring out what I'm really good at and wanting to help others. And what I'm really good at is usually like stepping into the fire. Like, I don't understand VC. Let me go join a VC fund. Like, who does that? That's so stupid. like I have a great paying job as a product manager leading my own division of a publicly traded company. That's so stupid. Who would do that? Well, okay, I would. I guess that's me, right? Like, so figuring out that I like jumped into stuff. Well, after Gabb, I was like, well, what's the worst part of entrepreneurship? And I was like, raising capital. It was literally the worst part. If we could have just gotten there. And I was like, I think I'm pretty good at translating. Like, I used to translate statistical results to all the technical people or to the people that didn't understand anything technical, understand the numbers. I'm like, I'm pretty good at translating. So I understand what VCs really want. It's just digging into what their thesis is and then being able to like filter through that. And so I built this basically unpaid brokerage where I was just helping founders for free, connect them to other VC funds. And then I got the right to invest right alongside those VC funds. And then I turn around to high net worth individuals and say, hey, you can invest as well. I think you should invest because you can add value to this company. And then that made the founders even happier that I helped them find their lead investor. And I brought individuals who could add value to their company or were passionate about it. And they were like, this is amazing. And so I created my own version of venture capital without having a fund. And I did like 65 deals in 3 years. And like, honestly, nothing glamorous about it. I was like talking to people to beg them to invest $10K into a company that I believed in. And I convinced, luckily, a fourth party to pay me a salary to be their customer to do it using their tax and advisory services. And so I was making everyone win. It was a win-win-win for 5 different parties. The founders, the VCs, my investors, they were getting better terms than a VC fund, my employer technically, and then I was getting a small piece of carry. And so I was like, all right, I figured it out. I created this weird model that shouldn't exist. And then that tax advisory service went under. Again, for me, that was another breaking point of like, let me show them my true colors. Like, I brought all these investors into these deals. The firm had structured them so they were the manager. I had to carve out all of those assets, pay out of pocket to protect my investors, even though I wasn't getting paid from those investments, and just feel like, okay, what matters again? What's important? What matters is the relationships I built and doing the right thing and supporting those things. So did that, decided to build a debt company almost on the same model, just helping people find private lending funds. Private credit is what it's called. So just inventory financing, line of credit, equipment. Why don't we just help those people for free, find those groups, and those groups kind of struggle with marketing to find companies that qualify for their lending options. And except for this was about getting cash flow companies, not startups. And we would actually get paid rather than get equity upside. So
this has been for the last 3 or 4 years, and it's brought you to Initiator Co. And Tribe Angels, and you have your own angel investing arm.
So I have my own angel investment group. I have a in-person group here in Utah called Tribe Angels, where we talk about cash flow investing, real estate investing, equity investing. Because I wish someone would have slapped me in the face and just said, invest in more real estate earlier on, you idiot. Like, I love venture, and so I would have put all of my money and net worth into venture. I wish someone would have said, like, hey, maybe let's do like 75% real estate, and then you use that real estate cash flow to invest in startups, because you love that. But let's get the cash flow engine coming. Right?
Okay, so let's talk about this. So let's pivot. This is the world that you live in. You do this every day.
World.
And if any entrepreneur is listening, reach out to Landon. You can help them get. This is what you do. So
less so on the equity. I'll slow things down on the equity standpoint.
Okay, well, we're about to jump into that. So I want to know first if you could just explain what bootstrapping is and when it should be done versus the alternative and what other alternatives exist.
So bootstrapping is basically not raising money, right? Figuring out how to make money immediately, right? That's essentially my definition of bootstrapping. People will throw in other terms like, I bootstrapped, but I raised $500K from my friends and family. That's not bootstrapping. So I think that applies to over 90% of businesses, right? I talked about how that fits. There's probably that gap there of 7% that you might need a business partner or friends and family to throw in some money, right? And then the 3% that need to go raise VC dollars.
I give advice to people so often, and it's only for a specific like if you have a company that's structured that needs it needs outside capital. I understand that. Or if there's this land grab for this specific market.
If you're going to go take over the world, if it's a big enough problem, then maybe you should justify venture.
But if you're not creative enough to figure out how to bootstrap your company, I don't know if you're going to be able to, if you can't solve that problem, there's so many problems that exist in business that I don't know if you're going to have the stomach to solve the next one and the next one and the next one. Yeah,
that's why I give those proportions to say hey, 90% of people, if you're listening to me or watching the video, it's like you need to find a way to make money or else you're going to have to quit this in 6 months to a year. Because, and people are like, well, I don't have the money. I'm like, then you probably shouldn't start a company, right? Like if you can't handle the fact that you're not going to take a paycheck from your own company for a little while, you need to start either a different kind of company that can, or maybe it's not the right time for you, which is a really hard thing to tell someone.
Yes.
You can't handle this right now, right? Or I would say point to the 50% of businesses that are service-related businesses where you're like, I am trading my time for money. And that's a way to cash flow immediately. That's where most entrepreneurs get started, is they start a service business. So I don't care if you're a digital marketing agency, if you're legal services, if you're whatever, like architectural services, those are things that you can do. Your biggest hurdle there is just getting clients. So just build more relationships, or start once you have the relationships or have the reputation or something. Those businesses are the way to get money. The other ones take maybe a little more time. Oh, I've created this new product, so you have to like invest your own dollars to like make a product, show that it functions, a new microphone, and it works this way. Well, you better know something about microphones before you do it.
And you better have, I hear so many entrepreneurs that say, I just need capital so that we can do some R&D and build this out and order the bulk amount because the manufacturer won't. Like, no. Sell 10 of them, sell 20 of them,
Indiegogo,
or run a
like,
Kickstarter campaign to get some cash to do it, but sell a product that's not built yet to make sure that the demand's there instead of building something that nobody needs.
There are business models that require that, and I'm not gonna like biopharma, right? Like you're never gonna survive without raising capital, right? SaaS software, I get it for many situations because you have to hire engineers if you're not a technical person to do it, or you always say there's always an other option, and the other option is like you tell someone about what you're doing and they're so excited and they are technical that they're willing to trade their time for equity because of what you're telling them you're going to go build, right? There's always
which is raising, right? But such a smarter way to raise.
Maybe, yeah. I mean, like it all depends. There's always ors, right? Like you're trading something. So what are you trading? And yeah, I would say no matter what though, you should be obsessed. Like you should be obsessed about who your customers are, how they think, what do they do, what do they look for, who's listening to this podcast? Are these entrepreneurs that are trying to raise equity because they're going after the big thing? Are these entrepreneurs that are cash flowing and they need to figure out what's next, how to get that next step of growth, right? Like that's going to change what you and I should talk about because we care about our clients, right? And so that's the conversation that I like to have. For entrepreneurs that I do invest in, equity dollars, I'd like to see that they have like, it's this weird number of like 7 years of industry experience of like either a specific skill set that they've been doing for that time period, at least 7 years, or that they've been in that industry at least 7 years to where they know what's wrong. And they're telling me this is the product or this is the service, and I'm applying this skill set or I'm applying this insight, this unique market insight that is why my industry is broken, and they're going after it. Like that's one of the attributes I look for. That's
such a good litmus test, because I think what people often do is they say, hey, I see this adjacent industry or completely unrelated industry. They should be doing it this way.
Yeah.
But if you were actually in the industry, you would have had that thought and know that's why this solution is not going to work to solve this problem.
Yeah, you can pre-vet the failures potentially. Or you can say, this just needs a new view and I can disrupt it.
So I'm curious on the different vehicles, if you can go through, if somebody does want to raise capital, at which stage should they?
Yeah.
And why? And what are the different vehicles from debt to equity and other?
Yeah, so I'm not going to call debt raising capital because I'm not going to lie. I hear so many comments about, oh, we're just doing a little bridge thing. If it's use debt for things that are predictable, use equity for things you haven't figured out yet. I'll repeat it because I feel like I have to like shout it into the rooftops till people finally get it. Debt is for what's predictable, and equity is for things you haven't figured out yet. So you are giving up the largest interest loan you've ever given, called equity, to people because you haven't figured stuff out yet. So like you said, because you're never going to be the type that raises venture capital, okay, well, I'm not willing to give up because I believe in my product, my offering, my service, that I'm going to be able to cash flow and get that structure. Debt providers will look at like equipment financing, line of credit, purchase order financing. You have to actually have done something, show a track record, and you have to do it enough that you're actually making money at it, because their biggest risk is, how do I not lose my money, is their goal. I'm lending to you because I feel very confident that I'm not going to lose my money. Well, you're not going to get them to even look at you, or they look at you how you look on paper. How many negative days do you have in the bank, right? Like that's going to be a red flag that you don't have the ability to pay them back, or How much revenue do you actually have? So those doors only start to open when you've built a real company, when you've obsessed, when you've validated, when you've gotten those things, you're making money. There kind of is a threshold. It's like if you're doing 500K of revenue, you could probably get some sort of small line of credit. More likely, probably $1 million to $10 million, you'll get more debt options. And people think, oh, the banks will want me. I believe banks don't secretly want you until you're doing 50 million of revenue. They want you, but for your deposits, but not to lend to you.
They want you for your retail business.
Yeah. They want your deposits, but they don't want to lend, is my perspective. And it's because of regulation that's forced them into that behavior, forcing them to have a certain amount kept on the balance sheets, forcing them to have an audit trail of why they're lending. It used to be, hey, Court, I really like your idea. I'd love to lend to your business. Well, now they have to provide an audit trail of why they specifically felt comfortable lending to you. Well, all of a sudden now they're not comfortable lending to Court anymore because of the retail shop you're running next door, right? And so that's the debt world. The equity world, if you want to try and control the situation, raising once you have 25,000 of monthly recurring or 50,000, you can kind of control the story, right? The secret is every venture capital company company that's raising venture capital is going to die if they don't raise capital. It's the ironic thing. But yet they're trying to build a demand from people to say, you need to give us money because we have such big upside. That's what's going to work.
This is just a catch-22. How's that solved?
It's right. It's your team is so good. Your idea is really interesting. And more importantly, the upside is big enough to justify someone risking the 30% likelihood that you succeed or the 20% likelihood to succeed. So like if you're raising venture, it better be one freaking giant deal. And then there's a few options in between those two extremes, right? Private equity only applies once you've built a real company with lots of cash flow, minimum of $2 million of cash flow to the bottom line, probably more likely 5 and 10. That's where private equity comes in. They're not taking risks. They're buying established businesses, majority ownership typically. There's a few options in between, but it comes from people you know almost always, like 95% of the time. It's like, hey, I've built this company. We've got 250,000 of revenue. I think we can get to $1 million if we just do these things, and then we won't need to raise money ever again. That's pretty common, and I'll make you an owner, and we'll plan to give these kind of dividends and all this thing, and you show a line of sight to them making money on their money. People will look at that. If they know you, they trust you, they see validation from the numbers, but that's such a small percent. There's like this giant chasm of debt world is huge. Equity world is pretty big. There's very little in between those two of like, where are you? And it comes from the people you know almost always. And so pointing to just traction, revenue, and making money for debt, and that's the way to do it.
So walk me through an entrepreneur's journey. If they're needing capital, they call you up and say, hey, help me out. What does the process look like? What are they typically at with their business?
So I'm going to force you to tell me are we talking about equity? Or are we talking about debt?
For Initiator Co.
Initiator is all debt, so I don't touch equity in that standpoint. So
no equity at all. But you do have this huge network of VCs, and you've done this.
Yeah.
Do you do that for free, or is that still something?
If I see an opportunity that I'm willing to make an exception and bet my reputation on it, yeah. So it's one of those that's like, there's got to be something special. That's why I was like, I don't want people to reach out to me for equity right now because, it's going to take something special for me to do it. Now, I have one of those right now, and I'm excited and giddy, but like that's very uncommon. So Initiator, it's all about cash flow. If you run a profitable business like you, like every business is growing, and there's always, as businesses grow, there's always working capital needs. Working capital is just the amount of money in the company to make it run, right? Like you're growing too fast and you're like, oh gosh, we just closed 3 new contracts and we need to hire 2 more people to fulfill them, but we're not getting paid till this happens. So you would use contract financing to be able to hire those people ahead of time. Or your company's growing, but you're selling to Walmart and their receivables only come in after 90 days. And so you're like, this is getting bigger and bigger, this 90-day wait time, and that's all our money. And so we need to get that now so we can buy the next tranche of inventory. All of those options, once you've reached 500K to $1 million to 5 million to 10 million, are available. Or even the large companies, it's even bigger problem for them if they're doing $20 million. So really, debt only comes into picture like once you have an established business. So people think, well, once I'm to this stage, the money will be there for me. That banks will just want to give me money. You have to prove to any lender why they want your money.
So this would be somebody that's tried to go to a bank. They have an established business. Maybe they're at $1 million in revenue.
Yep.
And the bank says, hey, you're not a fit.
Yeah. I mean, they say no for like 20 different reasons. We don't like your industry. You haven't been in business for 2 years. Your personal credit score is just not good enough for us. I don't know. We looked at your receivables and who's they're from, and we just don't feel comfortable. Oh, actually, they don't even do receivable financing, generally speaking, banks. So banks really have two products: line of credit and a term loan.
And so if that's not a fit for them,
that's not a fit, you have to go to
Initiator
Initiator
Co.
Yeah, and we're free to the companies to help them navigate across 90 different lenders. They get the same rate if they went to them to us or directly. So we're generally there to say, look, we've aligned incentives. We only get paid if we get you a successful loan, and it's not from you; it's from the lender, and you get the same rate from them. So, and they like us because we qualify and save them time. So that aligns perspectives.
Cool. That makes sense.
I'm a better point guard facilitator. That's just my life.
Okay, so I have 2 more questions, but one is on if you are raising for equity. I know you said you're in the debt space right now, but if somebody is raising for equity, is there a game to be played? And do you go after a term sheet, or are you going after an ideal partner?
So I would say my advice changes for every startup. I call it startuppreneurship versus entrepreneurship. Startuppreneurship is going down the venture path. Entrepreneurship is building a business that makes money. They are the same. They both fall under this
Hopefully
chasm.
they converge at some point.
They're the chasm of entrepreneurship, right? But startuppreneur is a different game than making money that other entrepreneurs go down. I would say your advice tends to be based upon who you are or where you're at. And the advice is either you have team, traction, or you really have truly differentiated product, technology, IP, something that's like, whoa, right? Like that's it's different. And you're figuring out where you're leading out. And is it your team is so good, then you lead out with your team in order to demonstrate how you're going to be successful. If the product and the IP is so good, you have to lead with that, but that's oftentimes the hardest time because we already know why companies fail. They don't get validation, they run out of money, and they often break up or whatever, right? So you have to do the backwards math of where is your weakness or where is your strength and figure out where you lead out with that strength. That's the game of how to attract capital is know your story. Practice telling your story hundreds of times to where it makes sense. And every time you're talking to someone, you're talking to a potential customer, a potential partner, a potential like fundraising journey. The reason why it's such a refining process is because you just have endless failure after failure. You're like, you do it so often that you're just like, I know what you're going to say and why you're going to not like it or what I think you're not going to like. And every question you get is like, oh, I should bring that part into the story. And so traction is always the one to lead out in if you can, right? If you have enough traction or enough partnerships that will allude to traction.
To de-risk
traction doesn't necessarily mean revenue. It just means enough things to demonstrate that you're most likely to win compared to others. Because Airbnb wasn't the only group that tried to create, shared, it was basically renting a room originally, right, in somebody's house, right? They weren't the only ones to think about that.
So if you are an entrepreneur, do you value the term sheet more or do you value the equity partner that you're partnering with?
That is a good question. He's basically asking, just want to restate the question to make sure people understand. Do you understand who's giving you the money? Do you care about who's giving you the money or do you care about the terms that they're giving you is really what you're asking. my advice changes for this one, unfortunately. I'll go generic answer. I'll put myself in a boring state. My generic answer is who's the person giving you money, because they're with you for that whole journey. When you hear entrepreneurs talk about their successes, they point to their first investors. They don't talk about the last investors that came in right before the IPO in the VC world. So your first investors, your first believers, because they're the ones you're probably going to call late at night when things are going poorly. And they're the ones that, you don't have to like sugarcoat things about like, oh, things are going great, my board. It's like you can call them and tell them. So who they are is more important. There are some business models that require you to maintain enough equity, because if not, you'll be screwed. But like those are ones that have to raise lots and lots of money. And so those are more mercenary founders that are going after a certain thing, and it's so big that they have to, create the next generation AI they need to maintain their equity, because they're going to have to keep raising until they actually make money.
Okay, last question for you.
Yeah.
Looking back to any of those moments in your life where you're broken, so it could be when you were 14, could be experience with Kickstarter, Gabb, or any of them. Yeah. That person is sitting across from you, that version of yourself in the past. Mm-hmm. What version is that, and what advice do you give that version of Landon? I
probably would have gone to myself. That was after Goldman. I was doing M&A transactions. When I wasn't broken, actually, is when I would have given myself the advice, because I think I learned wisdom from watching others, and I applied that. Like I applied forgiveness. I applied things that I needed to apply during those hard times. But the one that I wish I would have done, which was just like make the jump earlier, right? Like make the jump to feel comfortable failing. Like, what's the worst that happens? You fail, right? Like, are you going to give up? No? Okay, great. So if you're not going to give up, then why not fail or try to fail? Like, failure is just a tool to facilitate learning. And so I wish I would have like left the corporate world a little earlier to do that, or just stayed in the corporate world and decided that was like my life, and I would have had a pretty cushy life. So like for me, it was like, I wish I would have left earlier to challenge myself, because I think I missed out on probably 5 years of like really valuable learning. I mean, I've had a lot of valuable learning, but if I could have gotten 5 more years of experience of like something else that would have challenged me and maybe had me jump and try it and be less of a hesitant entrepreneur, that would have been helpful.
Take the leap sooner.
Yeah, take the leap.
You've taken it. I've seen you take lots of leaps.
Yeah.
But sooner.
Thank you.
Bro, thanks for joining, Landon. This has been amazing.
Thanks for chatting.
You've been watching Hello Grow, the world's #1 growth podcast. I'm Cortland Brady.
I'm Carlos Souza. If you've watched this video so far, it means that you like the content that we're putting out and the people we're interviewing.
We're putting together a community of business leaders, entrepreneurs, and sales leaders. You liking, subscribing, and sharing this content helps us reach those that are going on that journey.
If you want to be a part of this community, please subscribe, smash that like button, and turn on those notifications.